Hey all, welcome to ShareTreck. This is Raj here. Friends, are you looking at having a secure return without risking your capital? Are you hoping that as the interest rate falls, you get the advantage of capital gain, but at the same time not have any risk of losing your capital? I think this video is for you. So today I'm going to talk to you about bond ETFs. I have selected 4 of them, and the next video also is going to be on gold ETFs, because these are 2 categories that are alternative to equity shares. So let's get started. Welcome back, friends. In my earlier video, I had spoken to you about my need to examine bonds, because as the interest rates fall, the bond face value will go up, which is a lot of capital gains. And when we buy the bonds, if they are priced so that we get a 5% interest rate, then we are going to continue getting the same return, but we are also going to get capital gains because the face value of the bond will go up. So I'm thinking that now that interest rate has been so high and the Fed has been reluctant to cut interest rates, but at the same time they're reluctant to talk about increasing the interest rates, I'm thinking that we have come to an inflection point where it would be ideal to buy bonds. But as a retail investor, I do not have access to bonds, and I do not want to manage that in a separate portfolio. So what I'm going to do is I'm going to use ETFs for that purpose. And I'm also thinking that as I grow older, I should move a good portion of my money into bonds as well as into gold. So in a later video, I'll be talking about gold ETFs. So today, let's kick things off with a simple definition of what a bond ETF is before delving into long-term bond ETFs. So what exactly is a bond ETF? Imagine it as a basket filled with a variety of bonds, all neatly packaged and traded on the stock market just like regular stock. These exchange traded funds are like a one-stop shop for bond investors, offering diversification, liquidity, and ease of trading. Now on to long-term bond ETFs. These are a specific type of ETF that focuses on bonds with maturities of 10-year or longer. They are like the marathon runners of the bond world, aiming for steady income and decent capital appreciation over the long haul. One key thing to note is that long-term bond ETFs are typically passively managed. This means they are designed to track the performance of a particular benchmark index rather than relying on active management decisions. By mirroring the index, these ETFs aim to replicate its holdings and performance, offering investors a straightforward way to invest in long-term bonds without the hassle of having to pick up individual securities and look at their ratings and so on. One of the big perks of long-term bond ETF seems to be its diversification. They spread the risk across a range of issuers and industries, reducing the impact of any single bond defaulting. Plus, they are more liquid than buying individual bonds since they trade on stock exchanges. This means you can easily buy and sell shares whenever you want. There is no liquidity constraint, unlike traditional bonds, which can be a bit trickier to offload. And here is the catch. Long-term bond ETFs are more sensitive to changes in interest rates compared to shorter-term bond funds. When interest rates go up, the prices of existing bonds in the ETF may drop, leading to some volatility. On the flip side, if interest rates fall, existing bond prices may rise, boosting the ETF's performance. So this is the aspect of the ETF that I am trying to target, and I think that's the reason why this is the time I feel is right for me to get into bond ETFs. So there you have it. Long-term bond ETFs are like the steady yet sensitive giants of the bond market, offering investors a mix of stability, diversification, and potential for growth over the long run. And I'm going to present my 4 bond ETF choices to you. And please keep in mind that what I have tried to do here is to look at the quality of the portfolio. I am aiming to have more of government bonds, and if I have non-government bonds or corporate bonds, I want them to be AAA rated. So I'm trying to avoid B-rated bond holdings in the portfolio. And that's the basis on which I have chosen my 4 bond ETF choices. And they have been organized in the sequence of their expense ratio. I have taken the expense ratio as a guidance. The lesser the expense ratio, the earlier I will talk about them. The higher the expense ratio, the later I will talk about them. That does not have any reflection on the quality of their portfolio. That said, iShares 10 plus year investment grade corporate bond ETF or IGLB, that is a ticker symbol, is my choice. Is one of my choices, one of my 4 choices. It last closed at around $50.19 and it has an expense ratio of 0.04%. And its portfolio consists of more than 3,500 issues with minimal default risk. A 30-day SEC yield of 6.2% and monthly distributions provide dependable cash flow for income investors. And the majority of corporate bonds are rated A or BBB, with approximately 10% of issues rated AA. And the 30-day SEC yield, that terminology refers to a standardized calculation mandated by SEC for mutual funds and ETFs. It represents the yield a fund could theoretically achieve over the next 30 days based on its current holdings and income distributions after deducting expenses. It's a way for investors to compare the income potential of different funds on a standardized basis. So I'm not considering those aspects at this point of time. All I'm considering is the expense ratio and the portfolio components. And the next ETF I'm looking at is Vanguard Long-Term Bond ETF. It is called BLV. That is the ticker symbol, BLV. It last closed at 22.64 and it has an expense ratio of 0.04%. And it contains high quality corporate bonds with maturities between 10 and 25 years. However, it also contains BBB minus rated bonds. So I looked at all the ETFs and all of them contain something or the other. So I'm not a great fan of this particular ETF, but I wanted to have a choice of at least 4 to look at. So I selected BLV. And the next one is SPDR Portfolio Long-Term Corporate Bond ETF. Its ticker symbol is SPLB. It last closed at $70.26 and it has an expense ratio of 0.04%. It contains approximately around 3,000 bonds. This is well diversified fund that denotes 46% of its assets to US government bonds. So this is the bond that ETF that I really like. And it makes about half the income exempt from the state and local taxes. So because it is government bonds, the state and local taxes go away. And the remaining portion is investment grade corporate bonds. So I like this one. Then I have iShares 20 plus year treasury bond ETF or TLT. Again, this seems to be a really good ETF. Last, it closed at $91.39 and it has a slightly higher expense ratio of 0.15% because this also contains around 40 treasuries with an average SEC yield near 4%. I think for those living in the US, this can be a good choice for investors who live in high tax states because its income is exempt from state tax, but you have to pay federal tax on it. The other attraction on this fund is that it will have an increase in its face value as interest rates start to fall. So that's the other aspect that is very interesting for me when it comes to TLT. So there you have it, friends. These are my 4 picks on bond ETFs. I looked at many of them and there are some terminologies that are confusing. And again, the face value of the bond and the yield, all these things are interrelated and it's a bit confusing and counterintuitive. So the best way to remember that is that when your interest rate goes up, the bond face value will go down because in order to get that higher interest rate, people will pay less to buy the bond so that the rate of return for them is higher. That's the way you have to remember it. Conversely, if the interest rate falls, people will pay more to buy the bond because a higher face value will give a lower interest. So that's the way I understand it and that's the way I try to remember it. So my case is that I'm approaching 60 and I want to have a little bit of stability in my portfolio. I want to reduce my risk and I want to look at bond. As a retail investor, I have limited means of screening the bonds and keeping track of everything. So I'm going to go for a bond ETF. And even though I have organized these lists according to expense ratio, starting with the lowest, when it comes to actually buying the bond, I would go for a bond even if it has got a higher expense ratio. If the portfolio contains a greater deal of US treasuries, I think I would be more comfortable with that as compared to corporate bonds and others because we want to save capital and we want to be risk averse. And the other reason is that I'm thinking that if I do it in the next short period of time, within a month or so, I would be able to get a really good face value for the bond. And then when the interest rates start going down, I can enjoy the capital gains as well while getting a higher rate of return on the money invested. So friends, there you have it. That was my foray into bond ETFs. I hope you liked this video, and I would like to get your comments. Put your comments below. Do you hold any bonds? Do you hold bond ETFs? And what are your thoughts about investing in bond ETF? And with this, I would like to end this video here. And again, for the members, I would like to remind them that on Sunday we have our happy hour Zoom meeting. So please join me there, and I'm looking forward to see you. And we'll have a good chat on various things in the market, and also do a little bit of technical analysis here and there on some interesting stocks. With that, my friends, I'd like to bring this video to an end. Catch up with you again in the next video. Bye for now.